That sound, the screech, metal grinding on metal. You've heard it before, not on any track, but in your bank account. Every time you check your net worth and find it barely moved from last quarter, that's the sound, that's the brake engaging. And you've been the one pulling the cord. You're not broke, that's what makes this so disorienting. You make money, maybe decent money, you work hard, you're not reckless. But every month ends the same way, a little more spent than planned, a little less saved than intended, and a quiet, uncomfortable question sitting in the back of your skull. Why am I not further along? You've told yourself the answer is income, that when you finally earn more, the math will sort itself out. A raise, a promotion, a better year. That's not the answer. The answer is momentum. There's a law, not a mindset philosophy, not a motivational framework, an actual physical law that governs exactly why some people watch their wealth accelerate toward financial freedom while others spend their entire lives standing at the station, watching the train disappear. And here's what nobody tells you: you might be applying the brakes right now, every single day, without realizing it. And every day you don't understand this, the gap between where you are and where you could be gets measurably wider. That's not a threat, that's just what momentum does when it's being destroyed. Newton's first law: an object in motion stays in motion unless an external force stops it. In physics, momentum equals mass times velocity. That formula isn't a metaphor for wealth building, it's the actual operating system. Your financial mass, the weight behind your trajectory, is your invested capital. The larger your investment portfolio, the heavier your train. Your financial velocity, how fast you're feeding the engine, is your savings rate. The higher the percentage of income you deploy into assets, the faster you accelerate. Momentum equals mass times velocity. Now think about what happens when you pull capital out of the market to fund a lifestyle upgrade. Your mass drops. Think about what happens when you cut your savings rate to cover a new monthly expense. Your velocity drops. Do both at the same time, which most people do constantly, and the train doesn't just slow. It stops. And a stopped wealth train doesn't coast, it costs. Every month you're not compounding, you're not just missing growth, you're delaying your date of freedom. Not by days, by years. The opportunity cost isn't a fee you see on a statement. It's a sentence, a longer one than you think. Let's talk about mass, because this is where most people misunderstand how to build wealth fast. When you have $5,000 invested at 7% annually, you're generating $350 a year. That barely registers. It's easy to dismiss. Easy to rationalize pulling out for a weekend, an upgrade, adjust this once. The number feels too small to protect. But here's what you're actually protecting: the foundation. Because compound interest investing doesn't reward the first dollar. It rewards the accumulation of dollars over time. That $5,000 becomes $10,000 in a decade, then $20,000, then $40,000. The growth rate never changes, but the base it's growing from keeps expanding. Your money starts generating its own workers, dollars hiring dollars, compounding without your involvement. That's the engine, and the fuel is your savings rate. There's a specific milestone in wealth building that physically separates the people who eventually get there from the people who quit. It's the first $100,000. Not because the amount is life-changing, but because of what the physics do at that threshold. Below $100K, your velocity, your savings rate, is doing almost all the heavy lifting. Your compound interest is real but small. You're contributing $1,000 a month, and your investments are generating maybe $3,500 a year in growth. You are still the primary engine. The math feels slow because it is slow. The moment you cross $100K, the mass begins to carry its own weight. Your portfolio starts generating $7,000, $10,000, $14,000 annually on its own. The compound interest stops being background noise and starts looking like a second income, not because you did anything different, because the physics flipped. This is why the first $100K feels like pushing a freight train up a mountain. You're fighting gravity and inertia simultaneously. But here's what almost no one talks about. The moment you crest that ridge, gravity reverses. Suddenly you're the one being pulled. Most people stop pushing right before that happens. They buy comfort. They upgrade the lifestyle. They interpret the slowness as evidence that it isn't working, rather than evidence that the hardest gear is almost cleared. Here's the shift that separates a passenger from an engineer. When a passenger looks at $1,000, the question is automatic: what can I get with this? When an engineer looks at $1,000, the question is completely different. How many workers can I hire with this? Think about that framing. A $1,000 investment deployed into a diversified investment portfolio, growth stocks, high-yield dividends, index funds, is hiring at average market returns roughly $70 workers, each earning about $70 per year forever, reinvesting their own wages, hiring their own replacements from their compounded earnings. They don't call in sick, they don't quit, they don't need benefits. They work every hour of every day, including while you sleep, including weekends, including the days you don't even think about your portfolio. Every time you deploy capital into assets, into passive income streams, into an investment portfolio built for the long term, you are expanding that workforce. And every time you pull capital out to fund something that depreciates the moment you touch it, you are not just spending. You are firing your workforce. The consumer mindset asks, how much pleasure can this money buy me right now? The owner mindset asks, how many years of freedom can this money buy me later? These are not personality types, they are operating systems, and you can switch. Here's what no one in the financial industry wants to say loudly. The modern economy is specifically engineered to interrupt your momentum. Every subscription renewal notification, every 18 months same as cash offer designed to feel like smart math, every algorithm that knows your spending patterns and places the upgrade exactly where you'll see it when your resistance is lowest. Every social signal telling you that you earned it, you deserve it, you've worked hard enough to reward yourself. Each one is a hand on the brake cord. Strategic asset allocation and real risk management don't just mean choosing the right stocks. They mean protecting your velocity from the constant gravitational pull of lifestyle inflation. It means being conscious of what each purchase actually costs, not the price tag, but the momentum cost, the compounding you're pausing, the workers you're not hiring. This is not about living small, it's about building intentionally. Most people won't ever run this math. They'll stay passengers because it's comfortable and because a stationary train is remarkably good at feeling like motion. Climate control, reclining seats, the smooth hum of an engine that isn't going anywhere. They'll reach a certain point in life, look out the window, and realize the view hasn't changed in years. Here's the calculation that changes everything. 3 variables: your income, your monthly invested capital, your savings rate, the percentage of income you actually deploy into assets rather than consume. At a 15% savings rate, consistent contributions, and average market returns, most people reach financial independence in roughly 43 years. Push that savings rate to 20%, you're at 40 years. Now redirect just 5% more of your income. 5%, not half your lifestyle, not a dramatic sacrifice. One meaningful, intentional redirect of 5% of what you currently consume toward assets. That single adjustment, run forward through compound interest investing over time, moves your date of freedom forward by an average of 7 years. 7 years of your life, not recovered by earning more, not recovered by finding the perfect growth stocks or timing the market or landing a windfall. Recovered by redirecting 5% of existing spending toward your financial velocity. The math doesn't care about your income level. The physics of savings rate as the engine of financial independence work proportionally at every income bracket, because momentum is a ratio, not a number. That's what makes this violent. You don't need a different life to change the outcome. You need a different operating system. So here's what you carry out of this. Every dollar that passes through your hands, is it a passenger, or is it pulling something forward? You don't need to be extreme. You don't need to eliminate every pleasure or treat every purchase like a moral decision. But you do need to see the math clearly enough to be intentional. Because tax mitigation, high-yield dividend reinvestment, growth stock allocation, passive income strategy, these are all accelerators. They only work on a train that's already moving. They require momentum to amplify. The foundation is always velocity. The foundation is your savings rate. The foundation is refusing to be the person who pulls the brake cord at the worst possible moment, right before the physics start working for you. The wealth train left the station a long time ago. Not your personal trains, the train of compounding. The market has been running. The math has been accruing. Every year you've been alive, the engine has been in motion, whether or not you had a ticket. Some people are on it, some are still watching from the platform, convinced they'll catch the next one. There is no next one. There is only this one and the decision about whether you're going to stop pulling the brake. The track ahead is long, the compounding is patient, but the passengers who switch to engineer, they're not wondering when they'll arrive. They already know.